You could be sitting on a six-figure tax bomb if you're thinking about downsizing, but you don't know exactly how to plan for it and what to do. Or you could be sitting on once-in-a-lifetime opportunity to create wealth and financial stability for your family in the years to come. Downsizing is not about limiting yourself. It's about right-sizing your life to fit the lifestyle that you wish to live at this stage in your life. It's about practicality, comfort, planning, protecting your family, your assets, and your peace of mind. It's also about preparing wisely to put your assets in the right entity and understanding the legal, financial, and tax strategies that can over time save you thousands of dollars. Could I have put more emphasis on this matter? I don't think so, but there is a reason for it. It really matters. And you're going to be so happy, and your family will be so grateful that you did that. The difference comes to two things: knowledge and planning. And that's what we are going to talk about. In this video, we are going to be talking about practical solutions, honest advice, and clear solutions based on our real estate expertise, financial planning, and tax strategies. And the person that gets the most benefit from these advice are you and your family. My name is Dar Marden. I'm a CPA and a realtor, and I live in Orange County. And when we are talking about downsizing, the first topic I'm going to talk about is estate planning, because that's the foundation of everything we need to do. Let's dive into it. If you're at this stage in your life and you're talking about family planning, estate planning, that means a lot has happened in your life. You have kids, you might have grandkids, you might have a blended family, you might be married, you might be single, and there might be a lot of complexities in your life. Your wishes, the way you want to distribute your assets to your heirs, the way you want to do the generational transfer might be different than the wishes of your current spouse and your family. And we want to make sure that we put everything in writing, so all the work you've done in your life and your legacy is protected based on your wishes, not somebody else's. There are a lot of complexities in life. You might have children that are not financially responsible, that they have health issues, that they are in troubling marriage, and you might not want to give their entire inheritance to them right away. You can plan for that accordingly in your trust. A will is not enough. You need to have a family trust. You decide how and when the assets are distributed, and you protect your family against the elements that they're dealing with. If you have a young family, this is your chance to protect their futures. God forbid something happened to you and your spouse. You can decide who's going to be the guardian, how they're going to be raised, with whom they're going to be living with, then allowing a court and a judge to make a decision when they don't even know your family dynamics. That's by far one of the most important things when you establish a family trust. If you have a family trust that has been set 10 years ago, you need to update it. Everything needs to get modified. And all your assets need to be placed inside the family trust. As you plan your legacy, you need to decide how and when your assets get divided and your heirs will receive them. If you have 3 children, you might as well consider having 3 separate properties that they can inherit after your passing, so there will not be any fighting what they're going to do with that property. Each one of them can have their own properties, so they can decide to keep it, live in it, or sell it. That's a very simple solution. If you have a trophy property, let's say a house on the water in Balboa Island, or a snow cabin in Aspen, you might want to keep that valuable asset in your trust and then allocate the options of what they're going to do with it and how it's going to be used. You might have a small business that you have worked on all your life. You can make the proper arrangement of what's going to happen to that business upon your passing, who's going to manage it, how the profits are going to get divided, if you're going to sell it, but they're all your wishes that can be implemented inside a trust. You can use the family trust to establish college funds for your grandchildren, so you make sure the asset stays protected and will grow until they're at the proper age, and they will always be in love with the grandparents because they paid for their college education. Establishing the family trust will avoid the confusion of what to do and how to do it. And even more importantly, you don't let a judge make a decision what's going to happen to your assets. A family trust bypasses all of these things, and it has some enormous tax advantages that we are going to talk about. If there are some valuable family heirlooms, if there are some personal properties that belong to you and your spouse, you can still put all of those in your estate planning. And I want to emphasize this. Setting up a family trust and taking care of your estate planning has very little to do with how much assets you have. That being said, the more assets you have, the more complicated the issue becomes for your heirs and how to divide those assets. But the general principle stays the same. You need to establish a family trust. Now, as far as the timing is concerned, the timing is always yesterday. And yesterday is gone, so it's about today. Please establish a family trust. I look at a lot of homes in Orange County, particularly in Newport, Irvine, and Mission Viejo, South Orange County. And 80 to 90% of those homes sit on an individual's name. They're not in a family trust. And I'm a CPA and a realtor. I keep repeating this. My work comes through real estate. And I'm emphasizing the biggest portion of this downsizing video talking about establishing a family trust. That's how important that is. There are two other things you need to do when you set up your family plan. One is you set up a healthcare directive that you decide what decisions will be made when the time comes that they need to make some difficult emergency medical decisions for you. You can make that directive right now. And the other thing is, if you have a young family, you establish a guardianship for your small children. And you put multiple people as guardians because some might not be available. And you decide how the financial matters are done for your kids. These are the absolute necessary steps that you have to do. The rest of the items we talked about, I'm going to put them in a list here, and I will also put them in the description below in the video. And the final note on this topic. If you have a family trust attorney that you trust and you work with and you're comfortable with, great. Give them a call. They will be more than happy to do that work for you. But if you don't, I know a lot of great attorneys that can cover all aspects of your estate planning, establishing a family trust, doing a healthcare directive, do the guardianship, put all your assets inside the trust. That is crucial. And I can make a referral for you. This is what I do. I'm a trusted advisor to my clients, and I hope to be a trusted advisor to you. If you need to talk to me, the contact information is in the link below. Just make an appointment and we will talk to each other. Also, go ahead and subscribe to our channel. Now, let's dive in to our next topic. The next thing we want to talk about is, what are we going to do with the investment? What are we going to do with the existing real estate and the existing assets? How are we going to do downsizing? There's actually an important point I need to mention. When we talk about setting up a family trust and we talk about estate planning on the financial side and so forth, we discuss a lot of financial options. That doesn't mean that everybody that sets up a family trust has all these assets. The main asset you have could be your family home, your pension, your 401k, or just your family home. That doesn't matter in the great scheme of things, because you still need to do your estate planning. You still need to set up the health directive. You still need to decide how the house gets divided, who gets it, who sells it, how it gets divided among your family. So it's not about how much assets you have. It's about knowing what the options are and what you can do. Now, there are going to be a lot of different classes of assets that you can have in your state. However, in this particular scenario that we're talking about, we are primarily going to talk about real estate. So if you have a very large home, or if you have a home that is very expensive and it has millions of dollars of equity in it, you don't necessarily have to sell this home, because when you sell that, you might trigger an enormous capital gains appreciation for yourself that you have to pay capital gains taxes on. So the alternative, one of the alternatives, is to keep the existing home you have and refinance it, or get a reverse mortgage. In either case, we might be able to take significant amount of equity out of your existing home without paying any capital gains taxes, and take advantage of the step up in basis, which we will cover in the next section, to avoid paying the capital gains taxes. Now let's talk about practical solution, how we can make that money work for you. Option one is to take the excess funds or the equity you have released from either the sale of your home or from financing it and so forth, and invest the money in an index fund or put it with a money manager to create an income stream for you in the future. That's definitely one option. But make sure, again, that wherever those assets are, they're placed in the trust, and they are eventually managed by your trustee. The second option is to use that extra money that you have got and buy additional investment properties to create a rental income for yourself. And while you are here, you're living, you're enjoying your life, you use that as additional income for yourself to maintain your lifestyle. If you want to travel, if you want to buy something nice for yourself, this is the income you're going to use. And then you can state in the trust how those assets get divided, which kid is going to receive what assets after your passing. Now, what I like about buying additional real estate is that extra money that we put in there, beside the rental income it's going to give you, it's going to give you this huge capital gains appreciation, particularly if you live in Southern California and you live in South Orange County. So you get the income plus the appreciation of the property. And if you did a reverse mortgage, your other home, your main home that we did a reverse mortgage, is also increasing in value. And your final option is actually automatic. It's called plan for the legacy and see your wealth increase and don't pay any taxes. So the way the tax laws are right now, actually, before I go there, let me tell you something. In Farsi, we have an expression that says, we hope you live to be 120 years old. So in this particular case, when you're 121 and you pass on and you pass away, there is this thing in the current tax law that's called step up in basis. That means each individual can have assets up to almost $14 million that no matter what the appreciation is on those assets, they don't have to pay capital gains taxes. So by you keeping the initial home, your first residence that we got the reverse mortgage on it, buy those investment properties, all that appreciation you have on your stocks, they all get this step up in basis. That means they become the current market value. Their value becomes their current market value. And any gain from the point you bought it until where it is today, that delta is tax-free. You don't pay any taxes on that. That is one of the greatest benefits of having a trust, because you decide how to spend the money later, who gets it, when they get it, how they spend it. And on top of that, you don't pay any taxes. You need somebody who can guide you through that process. I know I'm giving you this advice, okay, but this is a very general advice. You need to have an expert financial planner and wealth manager to guide you through that process. You need any referral, I can refer you to multiple people that know what they're doing. But this is one of the biggest, most important things that you can increase your wealth, create this enormous generational wealth. This is a golden opportunity you shouldn't miss. If you need people to make specific advice to you, exactly what to do and so forth, I have the people, I can refer you to them. Now, the summary of the financial strategies and what the steps are, I put them right here. You can see it. And I also put it in the description in the video as well. And you can't talk about downsizing without mentioning taxes, tax strategies, capital gains, and what we are going to do and what tax benefits are available to us. Item 1, capital gains exemption if you decide to sell your main residence. There is a rule under the tax law that says if you have lived your home for 2 out of the last 5 years and it's been your principal place of residence and you sell that home, if you are married, $500,000 of that gain is tax-free. If you're single, that gain is $250,000. Now, not everybody's going to have this ginormous, enormous capital gains in their home, but everybody's going to have some if you have lived in those properties. Those amounts are very significant because how often do you get a chance to have a $500,000 profit and don't pay any taxes on it? You want to make sure you incorporate that in our strategy when we talk about what we are going to do about downsizing. Item number 2, this is one of my favorite things. It's called Proposition 19. That means portability of your property tax from one property to the another. If you are 55 years old and you have your main principal place of residence and you sell that, you can transfer your property tax basis to the next home as long as the value is the same or less. If the value is higher, you still get a lower capital gains, lower property taxes, but it's subject to a formula, which is really easy to do. But let's say you have a home that you have $1 million or $500,000 profit in it, and you sell it, you go buy a property that's slightly less expensive than what you have, you spend the rest, you invest the rest of the money, or you plan to buy another property with the extra money. The property value, the tax basis from the old property transferred to the new property. You can do that across any county in the state of California, and you can do that 3 times in your lifetime. So that can save you tens of thousands of dollars or thousands of dollars annually on the taxes you don't pay. You can change where you live if you like to move near the water, if you like to move away from the water, let's say to some warmer place on Palm Spring, and you don't want to increase your tax basis. These are tremendous opportunities to take advantage of that rule. And as I said, now you can do it 3 times. If your house has also burned, you can take advantage of that even if you don't have the age requirement for that. The next item is 1031 exchange. If you're considering downsizing, moving your assets around and so forth, and you have an investment property that has not performed as well, or you think it has done well so far, but you don't think it's going to increase as much in the future, we can take that asset, sell it, and through a 1031 exchange, defer the taxes and put those properties in the trust. And then in the future, again, when you're past your 120 and you pass on, your heirs can receive those properties that you received that we did through the 1031 exchange and don't pay any taxes on the capital gains appreciation. That's a great sort of tax strategy and the way to get your investment properties and don't pay any gain on those capital gains taxes. And we are always looking for the solutions that are out there that are legal, and we can save all that wealth inside your family without paying the taxes to the government. And finally, if you're downsizing and you're selling that big home and you have a lot of furniture and you don't know what to do with them, you can donate those furnitures to the charities of your choice, and you can deduct the value of those contribution as a charitable contribution and tax return. These are just different strategies that can guide you through that process. I'm going to reiterate this point one more time. All the tax strategies we are talking about apply to you regardless of how much assets you have. The step up in basis and everything else applies to everybody. And I want to make sure you understand it's not about how much money you have, it's about how you plan for it accordingly and how you tell your heirs how the assets get divided. Now, this entire process is not as simple as it sounds. I actually put it to you like that so you understand. You educate yourself, you get the knowledge. You need to have a professional, somebody that does tax planning for you to connect with, and they can help you with that process. And even though I'm a CPA, I don't practice. I told you, I'm a realtor, but I have that knowledge. I can connect you with the right professional to help you with that. I put a summary of all the information we talked about on related to capital gains taxes, tax strategies, and so forth right here. And I'm going to put also all that information in the description to the video. So let me wrap up our session by saying you have worked all your life to provide your family and to protect them. You have created this wonderful life for yourself. Now you need to decide how you're going to simplify it with the right approach. If you don't know what you're supposed to do, it might create more chaos than provide a peace of mind to you. My advice and my direction is to educate yourself and do things the right way, so your legacy will endure for years and decades after you're here, and your family will love you forever. And that gives you a peace of mind to think you've done all that. I'm a trusted advisor to all of my clients and many of my friends. I appreciate that role because people put their trust in my knowledge. And I would love to be that trusted advisor to you and your family. But in order to do that, we need to connect. And in order to connect, you need to set up an appointment. The link for that is in the description below. Go ahead, book your appointment. Let's sit down and talk. It doesn't have to be about the transaction that you're going to do this week or next week. It's to build a relationship. It's for me to gain your trust and for you to get to know us. And hopefully we can work together. I look forward to connecting with you. Take care. I hope you find this video helpful. Please go ahead and subscribe to our channel and like the video so other people can benefit from it. Take care of yourself.